And greetings, everybody. Keith here. Hoping everybody's having a good day, enjoying life, living life, loving life. Want to remind everybody hit that like, share, and subscribe button. There's a PayPal link down there for anybody who wants to share some love. Every bit is appreciated. And of course, the StreamYard link is down there for anybody who wants to join the panel. Today, we're going to talk about surety bonds versus letter of credit as it relates to the sureties and these trusts and everything. We're going to get right into it with a thing from Harvard University Risk Management and Audit Services. And this is what I've been talking about as it relates to doing forensic audits versus criminal audits. A criminal audit, you're investigating the people, and that's what they want the identification for, supposedly. But we've got to remember the identification is the individual's name and number identify the record, and it's a record-keeping system, and whoever's holding those records are the bondholders. They're the liable parties. When it comes to the municipalities, you've got your official leaders and public servants and everything, generally covered under a blanket bond or something. Same with your county. Generally, it's going to be like under a blanket surety bond. So the surety bond company is the one that's going to hold the bond, and then the principal is the people that they're bonding, and then the obligation is to the obligee. In other words, the beneficiary. The people that they're obligated to serve are the beneficiaries. We, the people. So let's get into it. Blow this up a little bit. Surety bonds. Unlike an insurance policy in which there are two parties to the agreement, the insurer and the insured, a surety bond is a three-party agreement consisting of the principal, like I said, your public servants, the party whose obligations are being guaranteed by the surety company, the obligee, the party requiring the bond, and who is also the beneficiary of the bond, and the surety company, typically a unit of a multi-line insurer, but can also be a specialty provider focusing exclusively on bonds, such as bail bonds. A surety obligation has similarities to an extension of credit by a bank as a borrower's or principal's obligations under a loan are guaranteed by a consignor, the surety. So the contract is between the surety bond company and the city officials, the public servants. That's where that contract is. That contract, provided in a public trust, is extended for the benefit of we, the people. And in the extension of credit, it's the bank. But understand, the extension of credit is by a bank, but the credit comes from oneself. There is an important distinction between a surety bond and insurance. A bond is a guarantee that the principal will perform. So when you go to a bail bondsman and you get a bond in your name, you're naming yourself as the principal. While at the same time, the surety bond that the city has already has you as a beneficiary, as we, the people. I hope you're understanding, guys. Everything's a trust, and if you learn how to put yourself in that trust in the right capacity, you'll be able to help show these people what's really going on, those that don't know. But there's going to be those that do know, and those are the ones you're going to learn to work with. I'm going to show you how I plan to work with these guys as we go over this. The obligation is detailed in the bond form and in any other documents incorporated by reference. Incorporated by reference. So you incorporate yourself by reference just by filling out that bail bond, such as a statute. So incorporated by reference, such as a statute. Such as a statute, which can only be incorporated or implemented by incorporation. So it's implemented in the corporate capacity by reference. Again, people, Congress makes rules for the government. These are just statutes known as rules for the government and contractors, or a construction contract. Officers and agents. Agents would be contractors. That ID that you get from the state qualifies you as a contractor. The Social Security card qualifies you as a contractor. You're holding it. You're in possession of an official document. Failure to completely perform all the obligations guaranteed by the bond or incorporated documents could result in a claim being made by the bond obligee for default. So failure for the public officials means that you have to quit claiming the resident, federal, state, or municipal officer or agent whose residence presence is deemed necessary by the board, proving that you're not in fact covered by that surety bond that they hold because you don't have an official office. You don't have an office to perform the functions thereof in the public. In the event a claim is filed, the surety company has a duty to determine whether the principal is in default and typically will begin an extensive investigation. The principal has a duty to cooperate with the investigation and may be required to reimburse the surety company for costs associated with the determination. It is also important to understand that the principal, example here, Harvard University, is legally obligated to reimburse, indemnify the surety for any and all loss incurred by the surety under the bond. Such loss costs, which may include attorney's fees, will be assessed back to the TUB and department requesting the bond. There are many different types of bonds. License and permit bonds. That license is a permit to do business. It's bonded. And you're named as a principal, even though the license shows that you're the beneficiary. How does that work? Second name on the instrument is the beneficiary. Right away, the first name is the state of Iowa. And then it says driver's license. Then it says Little, Keith, Orland. Right of way, sign or sidewalk bonds. That's your easements. Provides passage. Construction contract bonds. Fidelity bonds. Guess who holds the fidelity bond with the United States? The Postal Service. License and permit bonds, sometimes required by a municipality, typically the city of Cambridge or other public body, as a condition to granting a license or permit to engage in specified activity. So when they say you're driving or operating a motor vehicle, those are specified activities. It's the grammar. To engage in specified activity. How do you specify activity? With the language. It guarantees that the party seeking the license or permit will comply with applicable laws or regulations. It doesn't say that they have to. It's a guarantee on their consent and intent that under the license or permit they will comply with applicable laws or regulations. Again, by the language, it has to be applicable, right? So use the trust language and learn how to place yourself in that trust language and learn the trust laws so you know when they're trying to slip it in on you. These bonds are structured to provide indemnity guarantees to third parties who sustain injury or damage as a result of the party's activities, as described in the license or permit. Examples include guarantees for injuries to pedestrians from businesses that hang signs over public sidewalks. You cannot injure people in the public easements. See, that public easement starts at the center of the road and goes outward on both sides to a certain extent to include certain land off of the road so that people can travel on foot and post signs not in the traffic. You understand that? Not in the traffic. What's traffic, folks? Right-of-way, sign or sidewalk obstruction bonds required in order to secure a permit for right-of-way work along streets, highways, or other public roadways. Required in order to secure a permit for right-of-way work along streets, highways, or other public roadways. The permit is typically required by a city, county, or other local municipality for excavation, grading, sidewalk, encroachment, maintenance, or other roadway projects. Permit and right-of-way surety bonds ensure work is completed in compliance with local rules and regulations, along with job specifications and other contractual terms. When it comes to the third parties, the worker, the one employed to make sure it's done right, can also make a claim, an opposing claim, out of capacity if it's feasible through HIPAA and OSHA if he is injured during that and an accident occurs. But that's got to be done under an insurance claim, not a surety bond. They operate differently, folks. Just like a letter of credit operates differently. We're going to go over that. Construction contract bonds, aka contract bonds. A lot of people think when they say construction bonds, oh, they're talking about a construction project. Yeah, they're constructing a contract. Okay? Required to guarantee that a contractor will abide by the specifications of a construction job or contract. The bond ensures to the project owner that the contractor will perform the work and pay specified subcontractors like insurance agents and tax agents, laborers and material suppliers. Subcategories of construction bonds include bid, performance, and payment. Pre-qualification, payment, supply, and maintenance. Remember, we talked yesterday in the Real Party and Interest Kentucky Law Review, they mentioned the term chamferty. And when we looked it up, it talked about maintenance. We found out it was something to do with maintenance. I'm going to be going over that too. Fidelity, crime bonds. That's that bail bond. That's a fidelity bond. Protects clients and consumers from theft by the principal or their agents, employees related to fraud, forgery, alteration, or embezzlement of funds. This bond might be required for Harvard personnel collecting, managing funds, or processing payments on behalf of another party. So when these police officers are saying that you're committing crimes through traffic violations in an easement pathway regulated by the Postal Service, who's committing fraud, forgery, alteration, or embezzlement of funds? Do they have a fidelity bond to make sure that those citations that they pass out? See, they have construction bonds, and in order to be able to operate under that construction bond, that contract bond, and pass forth, back and forth, obligations and other securities of the United States, known as commercial paper, stamps and other representatives of value. Commercial paper is a representative of value. It's all simple language, folks. Departments being asked to post a surety bond by a municipality, business partner, or other external party can submit an electronic request here. Departments being asked to post a surety bond by a municipality, business partner, or other external party. Who's the external party? Is that the third party beneficiary? Are they taking advantage of that third party as an external party to the contract? So let's take a look at the next one I've got. This is Risk Strategies, Bryant Surety Bonds. So this is straight from a surety bond company. You can call them 866-450-3412 right there. And it says, let me blow this up. It says, what is the difference? What is the difference between surety bonds and bank letters of credit? Now, you might be wondering why this is there, and I'm going to dispel that for you later on. We're going to do another stream later. I'm going to go over some definitions and stuff to show you what banks and what banking is all about. Bank letters of credit. Construction projects require a serious risk management in place that guarantees their timely and quality completion, as well as delivery of agreed payments to all relevant parties. There are two common ways to manage risk in case of a contractor default or when contractual agreements are not met. Surety bond versus letter of credit. While both offer sound financial protection, surety bonds have many advantages over letters of credit in terms of coverage, cost, duration, and more. Most importantly, letters of credit do not guarantee the completion of the project, while surety bonds do. Okay? Equity imputes an intent to fulfill an obligation. The surety bond is going to help with the equity side. The letter of credit is going to help with the insurance side. What is a surety bond? A surety bond is a third-party agreement among an obligee, we the people who elected those officials, and allow them to appoint and assign other people with certain delegated powers. The entity owning the construction project. The entity owning the construction project. Again, it's we the people. It's a public trust, and the entity is we the people. Individually, it is each and every entitlement, entity being an entitlement, and an entitlement of the community as a whole as beneficiaries is one aspect of a hat that we carry throughout the day, no matter what we have that we do for work or a job. A principal, the construction contractor, and the surety, which provides the bonding. So it's telling you here that the obligee, entity owning the construction project, if you know the principal is the public officials and those public servants that are operating as trustees, and the surety is the surety company, then who are you? You're the one that's supposed to benefit from this. So again, equity imputes that the beneficiary is the true owner. The entity owning the construction project is the beneficiary once again. There are specific bonds that are used for construction projects. A performance bond acts as a guarantee that the contractor will perform all his obligations under the contractual agreement with the project owner. Okay, a payment bond, the labor or material bond, that's the contract bond, is a protection for subcontractors, workers, and suppliers against contractor non-payment. So you got a performance bond and a payment bond. What about that bid bond? How come you're not putting up your bid bond? Equal consideration, equal benefit, right? In contract form as one of the beneficiaries and not a contractor. You're going to settle some debts. That means you're the financer. Remember these terms. If you're actually going to go settle that debt, that means you're the one financing it. And if you're the one financing it, you're the one putting an end to it. So all it takes is letting them know, hey, I'm financing this. What is a letter of credit? A letter of credit is also an agreement between three parties. A project owner, a construction contractor, and a financial institution issuing the letter. So if I deposit a birth certificate with a directive to the trustee to issue a letter of credit to the municipality to finance any debts incurred, shouldn't I be able to just take those receipts to that banker and say, here's a debt that was incurred because I had to use a residential identification to have a bank account and a card so I could use the fiat currency system, but I'm truly the one that financed it to begin with. So the customer agrees to make that third party payment. Who's the third party? The beneficiary. So if the beneficiary is making the payment, the customer agrees to make the payment for the third party, so long as it's understood that the credit is given to the customer's account. Guess what? Is the customer and the beneficiary the same? Absolutely. It acts as a financial guarantee to the owner who can call on the letter at any time. It acts as a financial guarantee to the owner who can call on the letter at any time, and as an interest accumulating loan for the contractor. Who's the contractor, folks? The city. And as an interest accumulating loan for the contractor. The financial institution has no obligation to ensure the successful completion of the project. So you've got one that's going to ensure the loan. You got the other that's going to ensure the completion of the project. The two together, two heads are better than one, right? Right. Two heads are better than one, right. So you got a surety bond and a letter of credit from a beneficiary that's financing the damn thing to make sure it gets completed. There's no reason not to complete it if it's already financed. There are major differences between a letter of credit and a surety bond in terms of cost, duration, project coverage, requirements, and handling of claims. Let's explore the comparisons. And I want to remind everybody, I appreciate all of your support, so please remember to hit the like, share, and subscribe. There's a PayPal link in the details section for anybody who wants to share some love. And the panel link should be there for anybody who wants to come join the panel. First, we're going to read it, letter of credit, and then surety bond. And notice how they got this set up. This is actually quite an intellectual setup here. It's going to give you the parts, and each part is going to be separated for a letter of credit and surety bond, telling you the distinct differences. So this is basically showing you how they work together. Letter of credit fees amount to 1% of the contract amount that the letter covers, which in turn is about 5 to 10% of the whole contract price, multiplied by the years of the contract. The bid price includes the letter of credit cost. The surety bond cost varies for different projects. So it's saying you have to be involved in the project as a contractor, but is usually between 0.5% and 3% of the contract sum. The contract sum is different than the contract amount that covers the letter, or that the letter covers. You can cover the whole contract, or you can cover a portion of the contract. What's the contract? That they do their job. Pure and simple. Follow the contract you already have. What is done is what ought to be done. There is nothing new under the sun. I'm just helping you settle these matters by letting you know I am the one financing it. And therefore, let's get the ball rolling and understand your position in all of this. You don't get any credit except from me. I'm the owner. They know this. In the case of construction projects, the bid price includes the bond cost as well. The bid price includes the bond cost as well. And that's a construction project. So the bid price doesn't include the bond cost if it's not a construction project. The period of duration is usually 1 year, but may include automatic renewal, which is paid additionally. That's that 1 year contract. And you're just qualifying your capacity for a year. And then you call up and have another bond issued. Do the same thing. Just roll it over every year. The bond covers, under a surety bond, the bond covers the whole duration of the project, as well as a maintenance period that is agreed on top. Remember last night we spoke about champerty and maintenance. See, when you get that rental agreement and you agree to maintain, you're taking on as a contractor being a surety. That's how they're doing it. You agreed to the lease terms, which was to maintain the property. That's the term maintenance in a commercial instrument, negotiable, that you didn't know the terms and therefore didn't negotiate it, and they get away with it. I was a bitch ass slave too, folks. I was a fucking fool for years. I was a dumbass. I was a big dummy corporation too. A letter of credit can be issued for any percentage of the project contract amount, but it's usually between 5 to 10%. A letter of credit can be issued for any percentage of the project contract amount, but it's usually between 5 to 10%. Subcontractors, workers, and suppliers are not protected because they're protected under this. Surety bond covers 100% of the contract amount. The performance bond ensures full project completion, while the payment bond protects the subcontractors, workers, and suppliers, guaranteeing they're going to be paid. There's an additional 10% maintenance coverage for defects for 1 year after the project is completed. That's what the maintenance is. To discover defects. Discover defects by an investigation. Who does the investigation? The surety company. Is there a letter of credit to match up with that surety company showing what financed? Where the credit came from? Was it based on a pool of residents and their taxes and their income? You know, how much they make every year? Say, well, he makes enough. We'll get it from all these guys here in this school district or this tax voting zone. A financial institution investigates only the financial situation of the contractor. A financial institution investigates only the financial situation of the contractor. It checks whether the contractor can reimburse the costs in case the letter of credit is called on. It checks whether the contractor can reimburse the costs in case the letter of credit is called on. So if I have a letter of credit sitting there with the surety company, and I have to make a claim on their surety bond, I've already got a letter of credit saying I financed this motherfucking thing. And you're to investigate their records. They're the contractors. I'm the beneficiary. I'm the owner. I'm the one that financed it. Don't you get it? If this factor is deemed satisfactory, there are no further checks. The contractor needs to secure liquid assets that decrease her line of credit and are seen as a liability. Seen as a liability. Liquid assets seen as a liability. A surety bond provider examines the contractor's business in its entirety before underwriting a bond. This includes its finances, its settlements. Management, workload, and experience. The goal is to avoid default by judging in advance the ability of the contractor to finalize a project. Remember again that chamferty and maintenance. We talked about judging in advance. The bond does not undermine the borrowing capacity of the contractor and might be even seen as boosting his credit reputation. Wouldn't you feel better if you could issue that credit and know that since it's your community project that you own and you appreciate and you want to see it come to its fruition so you can see the fruits thereof, being careful to maintain good works that are profitable unto men? Credit reputation. When the project for handling claims, I guess I should have been reading these requirements for obtaining and then project coverage and cost and period duration were the first ones. And now we're on handling claims. When the project owner requests the payment of the letter of credit within its period coverage, the financial institution completes it. Is a surety bond company a financial institution? However, it does not provide support with the completion of the project. It only guarantees payment if the project doesn't get completed. And that's what the bond is for. Finance, settle, to end, to complete. So the owner needs to tackle this as well as claims by subcontractors, workers, and suppliers. So if the city workers are getting screwed in their employment, it's the rest of the people of the community, the owners, that are supposed to tackle this. This is what I hope to be helping spread, because it's truly, again, our responsibility, our obligation as beneficiaries. Even in trust law, it says the benefactor, beneficiary, can come forth and settle the estate. It's telling us that's one of our duties, one of our powers, one of our authorities. Why can't we encompass that by a good knowledge of how it operates and help provide for the completion and financing of everything? The letter of credit might not be enough to cover all costs. I don't know. That birth certificate there with that symbol on it, that seal, under the full faith and credit of the United States, seems to be almost unlimited. So I bet I could issue one for a year, and I bet the expenses for me and my companion living in trust on a private piece of property that we have construction contractors all involved in and making sure they do the job and have it come complete in a year, and then have another year's coverage after that to make sure that while we're living in it, everything comes to completion and is working properly, so we don't have to make a call on our letter of credit as to their contract that they've already been paid for, things like that. All you need to do is cover the cost for a year. What are your expenses for a year as a beneficiary? Start learning how to do the budget and understand that these other people need to get paid too. So if you really do want those public officials to hire and designate and authorize people in nice little uniforms and badges to supposedly protect the neighborhoods as community care under domestic tranquility and general welfare, then they should be abiding by that oath and and remember that surety bond there and the letter of credit that sits right there with it. And I will call on that, and you will be held in your individual and personal capacities for both breach of contract and breach of trust. When a contractor defaults, the surety provider investigates the case. When a contractor defaults, when a contractor violates his contract, in other words, if he violates the oath that he undertook, for public office as a trustee to perform public service under contract, he has first and foremost breached trust. And he has done so by breaching the contract because he's trying to hold somebody known as a beneficiary in contract that he's not specifically already involved in an official or agent capacity. There are certain inconsistencies. I don't care who claims to be a resident of the United States. I don't care who claims to be a citizen of the United States. There are certain inconsistencies that forgive you for that because you knew not. Forgive them, for they know not what they do. It can take a few courses of action. Provide financial or other support to the contractor. Ensure the completion of the project up to the bond's penal sum. This is why we learn those penal sums, Trezevant versus Tampa. Choose another contractor. Cover the bond's penal sum for the project owner, for performance bonds, and for subcontractors, workers, and suppliers for payment bonds. I think it's pretty simple, guys. The more we learn about this and more we see that the language concurs and correlates and shows us time and time again, you are the beneficiary. And by having that identification, that lays a presumption that you are now liable as a contractor of some sort, a contract postal unit, using a name and address, when you can use a number issued by a letter of credit in lieu of the name and address. Qualifying your juxtaposition as the beneficiary. Priority. The trust was generated and granted by the grantor grantee for the very purpose of issuing a benefit. If a trustee is involved, the benefit was not meant for the trustee, it was meant for a beneficiary, a third party. But the grantor grants a trust and names a trustor. The trustor creates the trust. That is a contract. Greetings, tribe. Permission is a license to do a thing or an authority to do an act. Without such authority would have been unlawful. License is permission to do a thing by an authority without such authority. See, the Congress makes rules for government. The license is giving you, as a government official or a contracting agent, permission to do which is otherwise unlawful. People don't know they are at the auction putting up bids. Absolutely. I don't know if you could directly relate it to surety, but it is a military term. Mr. and Mrs. Military. All right. Well, with that, folks, like I said, we're done at the end of our stream for this afternoon. I'll be back at 6 o'clock. I'll be back at 6 o'clock and 9 o'clock. 6 o'clock, we're going to bring you the Goon Squad as it relates to the Mississippi Police Force this last year that under Sheriff Brian Bailey committed some heinous acts. And of course, it seems to be quite racially motivated, but the topic I want to get there is much further, not just the color issue, but relative to the division issue of authority and what I've spoken about for a long time now, Hitler's willing executioners. That's literally what we're seeing. We're seeing goon squads. They call them goon squads. Special police squads. Go get yourself a copy of the book by Daniel Goldhagen, Hitler's Willing Executioners, and see how it was, how it progressed throughout Nazi Germany, throughout the people as a whole, as willing executioners, allowing their public officials to do the horrendous things that they did because they weren't personally involved. You are. You are. And with that, you guys know me. I love you, but I don't give a rat's ass whether you love me back or not. Let's say I don't care if you hate me. I don't care if you don't respect me. That's on you. So may God bless you. Have a good day. We'll see you later. Bye now.